One important refinement about GDP, and this relates to unsold inventory. You may already have been wondering how this is handled, because after all, I've been talking a lot about how there is an equivalence between production and expenditure, which makes it sound as if each and every period whatever is produced is actually purchased. But of course, that's not necessarily the case. It's often the case that firms will produce a certain amount of output in a period, but not necessarily sell all of it, and this gives rise to unsold inventory. Well, if there's unsold inventory, how is it possible for production and expenditure to give the same value for GDP? Well, it's actually not as big a problem as you might think, and it goes back to this notion of investment, of firms' investment being a type of expenditure in the economy. Remember, investment is all about an expenditure that happens in the present, but which meets a future need. Now think about unsold inventories. Unsold inventories are kept by firms precisely because they meet a future need. They're available to meet, let's say, an unexpected increase in demand in the future. So unsold inventories can be thought of as being a form of investment by the firm. So let me give you just a very simple example to show how all this works. Let's take the month of December 2012, and suppose in the economy there's been a flow of production equal to $1 billion, but over that month expenditure has fallen short. Expenditure is only 0.8 billion, meaning that firms have accumulated a change in inventories of $0.2 billion, essentially unsold stock. Now what we're going to do is as follows. We're going to take that 0.2 billion and recognise that firms are hanging on to those inventories to meet this future need, the possibility of being able to sell it in the future, and we're going to say that that is going to be equal to a part of firms' investment expenditure. So once you think about unsold inventories like that, what we actually have in this economy is production giving us a flow of $1 billion will in fact be equal to expenditure if we take expenditure as being that 0.8 billion and add to it the investment expenditure of firms in the form of inventory investment. So once we recognise inventory as part of investment, then even if not everything gets sold in a period, that equivalence between production and expenditure is still maintained. Well, let's suppose something different happens in the following month, January 2013. Once again, over that month, there's a flow of production equal to $1 billion. Well, let's suppose there's an increase in expenditure, $1.2 billion now. How is this even possible? It's possible because that unsold inventory is now being sold. So there will be a change in inventories, but it won't be adding to inventories, it'll be taking away. And so we record the change in inventories in this case as minus 0.2 billion. But again, this is going to be part of investment, but it's going to be negative investment. So what we have in this month, once again, there's a flow of production equal to 1 billion. And this is going to be equivalent to expenditure, because whilst we have this $1.2 billion of expenditure, we record the fall in inventories as negative investment. So we subtract the 0.2, and so once again we have this equivalence between production and expenditure. So we've done a lot in this lecture, but it's all going to be useful for us as we go through this course in macroeconomics. A lot of what we've done revolves around what is called the national income accounting identity, which is this idea that production, expenditure and income are actually three different words that mean exactly the same thing, and that is gross domestic product. And you'll soon get used to this idea, and you'll actually hear me in these lectures use those three terms interchangeably. Sometimes I'll talk about production, sometimes I'll talk about expenditure, sometimes I'll talk about income. It doesn't really matter which word I use, it all means GDP. And over the course of this subject, you will actually see how that national income accounting identity is used over and over and over again as we explore issues in macroeconomics. The other thing I want you to take away from this lecture is this notion that we often divide the economy into distinct sectors. We have our household sector. Now I'm just going to focus on expenditure here, but there's income flows going to all of these sectors as well. Our household sector is responsible for consumption spending, and given our assumptions, total consumption spending is spending on domestically produced goods and services and imports. Our firms, their expenditure is investment, plant, equipment, and inventory investment, changes in inventories. Our government is involved in expenditure. We'll just record that as G, and the foreign sector is involved here through its purchases of exports. As I said at the very outset of this lecture, a lot of macroeconomics is essentially trying to understand what is happening to gross domestic product. It's unlikely that we will have many lectures in this course where we're not talking, and often talking a lot, about gross domestic product. It is probably, certainly, the key macroeconomic performance indicator. The importance of GDP as an indicator of macroeconomic performance is highlighted in this chart. This shows the growth rate of GDP, how GDP has changed from year to year. And it's dominated by the global financial crisis. And this shows you the magnitude of the global financial crisis, what it meant for economies all over the world was a significant fall in gross domestic product. In other words, these economies shrank during the global financial crisis. The flow of economic activity contracted, and as you can see from this chart, contracted dramatically. All sorts of consequences flow from that observation that we're going to explore in this course. But gross domestic product is probably the key indicator of macroeconomic performance. And when something like the global financial crisis hits, fortunately that doesn't happen too often, the severity of the crisis in terms of what it means for macroeconomic performance is pretty stark when you start looking at what it means for gross domestic product. And even looking here, we can see Europe heading into negative territory, Japan perhaps also. A lot of our work will be understanding what is going on with gross domestic product. And it's true, and I've been emphasising that macroeconomists focus on gross domestic product a lot, and I think you can see why that's the case. As an indicator of macroeconomic performance, it's pretty hard to go past GDP. But I want to end this lecture looking at a broader question, and actually a question where there is a lot of debate and soul-searching that takes place in economics. This is the question of whether gross domestic product is anything more than an indicator of macroeconomic performance. Does it tell us anything about broader social welfare? This is something a lot of people and a lot of economists worry a great deal about. We spend so much of our time focusing on gross domestic product. Is this actually the right thing that we should be focusing on? One way of posing that question is the following. Is it necessarily the case that growing a nation's gross domestic product actually makes the citizens of that nation any happier? And there is actually a really exciting branch of economics that's developed in recent years looking at this question, known as the economics of happiness. Ultimately, the end result of all of this economic activity, one would like to think, is an improvement in people's welfare, an improvement in their life satisfaction, an improvement in their level of happiness. It turns out that this is a surprisingly controversial area in economics. The chart you're looking at has become very, very famous. It shows two lines going back to the 1970s, and this is data for the United States. The dashed line shows what's called real income per capita. This is just measured looking at United States real GDP per person, or if you like, on average, how much income do people in the United States have? And you can see from the chart that this has been trending upwards. So at the end of this period, average incomes in the United States significantly higher than they were at the beginning of this period. That's what we call economic growth. The other line on the chart, the solid line, the line labelled happiness, shows the results from a survey taken at regular intervals of a sample of the United States population, which simply asks people to rate their happiness. And you can see that it jumps up and down a little bit, but there's no long-run trend. On average, at the end of this period, people in the United States were about as happy as they were at the beginning of this period. So we have a bit of a conundrum in some sense. We have rising incomes, but not rising happiness. And a great many people have looked at this chart and come to the conclusion, well, we're actually, as economists, as macroeconomists, focusing on the wrong thing. Why are we trying to grow nations' GDP if it in fact is not making people any happier? Now there's an enormous amount of research in this area trying to interpret this result and come up with an answer to that question. As you can imagine, it's a pretty controversial area. I want to make a couple of observations about this. The first observation is that there are certainly a number of aspects of the quality of life, which do, in some fundamental way, seem to be related to what is happening to gross domestic product. We know, for example, that the quality of health care is often higher in those countries that have higher levels of GDP. And as a consequence, longevity, the amount of time that people can be expected to live, is often higher in those countries with higher GDP. Simply looking at this happiness graph shouldn't, I think, lead one to throw the concept of GDP out the window and say, well, it's not really that important. There is simply too much that affects people's welfare that does seem to be positively related with GDP. The other observation I want to make, and this is another famous chart, is that whilst something might be true for an advanced economy like the United States, doesn't necessarily make it true always. This is a really interesting piece of research which essentially looks again at this relationship between income and happiness, but does it for a group of people whose circumstances changed quite dramatically. This analysis was conducted on the citizens of the former East Germany, and it covers the period of reunification. Now, obviously, an enormous amount happened to those people as a result of the bringing together of the two Germanys. But one of the things that happened was a pretty dramatic increase in their average levels of income. And for those people, the research shows that that did coincide with an increase in their happiness. And so it may be that if we're just thinking about happiness per se, that if you take people whose incomes are relatively low and bring those incomes up to the level of other people, comparable people perhaps, maybe that does matter for happiness. So I think as macroeconomists we have a lot of work to do to really understand this link between GDP and happiness. I do know that looking at GDP, as we will in this course, is an extremely powerful way of thinking about macroeconomic performance, but I guess we shouldn't necessarily conclude that GDP is the be-all and end-all of human welfare, though I will defend the proposition that it is an important aspect of human welfare.